Hi, I'm Dr. Kevin Milo, one of the co-hosts of the Physician Empowerment Podcast. At Physician Empowerment, we're dedicated to improving the lives of Canadian physicians personally, professionally, and financially. If you're loving what you're listening to, let us know. We always want to hear your feedback. Connect with us. If you want to go further, we've got outstanding programming both in person and online. So look us up. But regardless, we hope you really enjoy this episode.
Welcome to the webinar. Happy New Year, everyone. And we're really excited to have Jason again to come to talk to us on a rather mysterious topic to most people, and that's about family trust and advantage of other trusts. And so you guys know Jason well, and so I'm going to just kickstart and say, well, Jason, why don't you walk us through why do we bother with trust and what are trusts?
Absolutely. First of all, hello, everyone. Happy New Year again. Good to be back. I hope everyone enjoyed your Jason Free couple masterclasses, because I think I'm back for another run here. So, but it's good to be back. Our masterclass is going to be on family trusts, trust generally, how they work, tax side to them, the legal side to them, all that. But to kick it off and to start us thinking about what a trust is and why they exist. Yeah, trusts have been around for centuries. They're an old English concept, came over to us as, of course, for the Commonwealth. And the history of trust actually arose from knights traveling off on the Crusades. They had this land they needed to leave behind. And so what would they do? They would basically charge people with looking after it for them in their stead. And this concept is really where trust came from. And modern day trusts, which is very much how they've always operated, is a trust is really a separation of what we call the beneficial interest on one hand and the legal interest on the other. So if you own a car, your own name, you have what we call the legal title to the car. Your name is on all the licenses, the registrations, all that stuff. But you also have beneficial ownership in that it's yours to do with as you will, to drive it when you want, to get car washes, to put whatever oil and gas you want into it. It's your car. When we make a trust, what you're actually doing is you're dividing those two things. You're saying, okay, I want to give the legal interest to one person to have and to own that property, but the benefit of that property is supposed to go to another person. So again, in our Old English context, they'd be giving it to their heirs who are remaining behind, the spouses who were left behind when these knights were going off on their crusades. Nowadays, no more knights going on crusades. We have doctors who have professional corporations or investment corporations, and they say, I want to, and maybe sometimes, especially nowadays over the holidays, you were thinking going to the hospital felt like going on a crusade.
Definitely.
A trying journey of, long hours. But yes, the idea is that you say, okay, I'm going to put this property into one person's name, the trustee's name, for the benefit of someone else. And oftentimes the person will include themselves in that list. The list will be themselves, their spouse, their children, grandchildren. But the idea is that, you've divided these two things. And so in order to have a trust, you need to have a minimum of three parties. I won't get into the other alternatives, but you have three parties to a trust. Mm-hmm. You have a settlor who creates the trust, and the settlor creates the trust by giving property to a trustee, and the trustee's responsibility is to look after that property for the beneficiary who benefits from it. So those are your three parties.
So before you go further, so that's the historical route, but what about, we all have, we're supposed to have wills. So can you tell us, what's the difference between trust and a will?
So a trust can arise in many different ways. Again, historically, in the old context, what I was referring to, the courts kind of created it. They said, oh, you want someone to look after this property, we have to put a name to this, and we have to start making rules around it so that we don't have scoundrels and criminals running away with the stuff they've been entrusted with. And so because of that, there's many ways trusts are basically creatures of the courts and what we call equity, where they're just rules of court that have created trusts. Now, several centuries later, we do have statutes that set out some of the call it the outer limits and the boundaries of rules of trust, but largely trusts are creatures of statute. And so you can, if someone on this call has a family trust, that's almost certainly a written down, discretionary, intentional, we call that an inter vivos trust, where you've made it in life, you've put it in writing, you have specific rules in the trust deed of how it's supposed to be run. You also have, though, trusts that are made when there's unjust enrichment. The old example before divorce and separation law got better, you'd have one spouse who stayed at home, one who went to work, they got divorced, and the one who stayed at home, they oftentimes would lose out unless the court put in a trust and said, look, this person was contributing to the marriage by staying at home, raising kids, looking after the house, and allowing the other spouse to go out and pursue their career. So the court says there's a trust there. Estates are basically the same thing. Estates are things that arise as a matter of law. Again, we have statutes that set out the rules of how estates work, but estates themselves are trusts. Someone passes away. What happens to their property? Well, the law says the property moves to either an executor or an administrator. That executor or administrator has to, again, look after the property for the benefit of the beneficiaries, either ones that are in a will, or if there's no will, then there's rules of what happens to the property if there's no will. But yeah, the role of the executor or the administrator is to be a steward of this property, to be a trustee of it for the beneficiaries, to administer the estate, pay off the debts, and if there's property left over, transfer it to the beneficiaries. So estates are trusts.
Right. So if we have a will, we found executors, do we still need a trust? Is it only for the rich? Like, I think that's one perception out there. Family trusts are just for the rich.
Not necessarily. Family trusts are for people who, can use or benefit from them. I do see a lot of cases where people throw in a family trust that maybe they don't really have a means to use it and to benefit from it, in which case that's probably, I would say, bad advice they received. But yes, most of the phenomenally wealthy people in the world do have many trusts, series of trusts and business trusts. And, if you're a politician, then you have what's called a blind trust, where you don't even know what the trustees are doing and you're sheltered from seeing it. If you can have business trusts that run your operations. But family trusts offer a whole host of both tax and non-tax benefits. And as with most things, I don't like to have the tax horse necessarily completely driving the wagon. I like to make sure that there's other reasons for doing what we're doing. Again, the added creditor protection, flexibility, future planning, opportunities, not necessarily the pure, I would say the obvious tax stuff that people talk about when they talk about trust, which we can.
Right. Let's just dive in a little bit into the non-tax side of benefits. Right. I was told many years ago when I was setting up my trust debts that trust is a lot more secure than will, because will is an open document. Anybody can see what you own, what you owe. Creditors can go after your estate. Can you explain that and expound on that?
Absolutely, yeah. So when you have a will, it has to go through what we call probate, basically where you go to court. That the executor who's taken over, it has to attest, hey, here's all the property, here's an itemization of it, here's its value, here's all the debts of the estate, and then here's a copy of the will, who's going to get it. And that can lead to, depending on the nature, the way the family dynamics work, it can lead to conflicts. Trusts do not enter the court record. If someone doesn't have a right to see the trust deed, then there's no obligation to show it to them. It's a private document. It's a contract between the three people. That's one thing. Sorry, I do want to rewind just to talk about that.
Sure.
Everyone here, most of the people here on the call have a corporation or are familiar with a corporation. So a corporation is what I call a creature of statute. Corporations only exist because the government says they exist. They have the rights that the government says they have, and they have, to some extent, they have charter rights. They have freedom of speech. They have the rights that make sense. They have freedom of speech, stuff like that. And they considered natural persons that they can enter into contracts, they can sue and be sued, all these things. Trusts are much more like partnerships. They're contracts between parties. They don't exist because the government says they exist. They exist because the courts have acknowledged these kind of relationships. They're a contract. And so everything that comes from what tells you what a trust can do, who's in charge of it, where those come from, it's all in the trust deed. So again, creatures of contract as opposed to creatures of statute. And now I've forgotten what the question was. we were talking about non-tax benefits.
That's right. Well, you did explain the difference between a trust and a corporation, right? I was just going to ask that question, but you answered that before I got to it already. Good. Now we circle back to what's the non-tax benefit like versus a will. What more additional benefits does a trust offer you?
Yeah, so a trust is sometimes referred to as a living will. First of all, it's going to outlive an estate. And again, the goal of the estate when someone passes away, the executors and administrators, their job is just to follow the directions in the will to the extent they can. If there's not enough property to make bequests, then all they do is pay off the debts and it's done. But otherwise, if they pay off the debts and there's some money left, they do what they're told and that's it. The trusts generally don't persist for extended periods of time. I've seen it happen. It's uncommon because there's nothing for them to really do after they, again, follow the instructions in the will. Mm-hmm. So a family trust, though, is different. A family trust can last for, it depends on what province you are and how it's made, but it can last 50 to 100 years with very specific rules on how the property is supposed to be administered and looked after and who it's for. As grandkids are born and great grandkids are born and great great grandkids are born, they can be added to the trust automatically to benefit from the property. So that's materially different than a will, where really, it's the people and the parties who are alive at the time of the will, at the time of the death, that can potentially get the property. Yeah.
So now I want to just diarize this length and the lifespan of the trust, because there's a procession of 21 years, but we'll do that a little bit later. I want to get back to, so a trust offers more protection than the will, right? So I heard that, let's say if the kid's spouse, they have a divorce, right? If you have a will, well, they can come and divide everything, right? Like fight in half and half. But if there's a family trust, potentially you can just put the name of the persons, like say the kids and the grandkids. If the kid's spouse wanted to claim something, they could be excluded so they can protect the family asset. Is there some truth to that?
Yes and no. So I'm not a family lawyer, so I won't delve too far into what comes into the family estate and what's divisible property. And generally, an inheritance to a kid, my understanding is that should be outside of divorce proceedings, unless the kid does something to bring it into the marriage. Buy a joint investment, buy a house, spend it all on vacation, stuff like that. Again, my understanding. It's been a decade since I took family law in law school. On the family trust side, generally we would just have the in my trusts, I normally just have the direct blood lineal descendants of the creators of the trust, and of course adopted children and stepchildren, as they so wish. But we don't usually include in-laws in the trust unless they kind of actively make that decision later down the line. It's kind of an ad hoc decision that they make at specific intervals, as opposed to having them being general beneficiaries of the trust. Mm-hmm. And the point of that is the courts have been pretty clear and consistent that as long as your trust isn't being made, in light of looming litigation to defeat creditors, it's legitimately made at a time when there's no trouble brewing. Courts are pretty clear that being a beneficiary of a trust, i.e. your kids and grandkids and great-grandkids, it's a nothing. It doesn't have any value. I certainly wouldn't buy Wing's kids' interests in his family trust for even $1, because I think Wing likes me, but I don't think he likes me enough to flow stuff through his family trust. Being a beneficiary of a trust, it's not owning property. It's an expectation that one day maybe you'll get property if a trustee exercises their discretion. So until that time, it's a nothing. And so what that means is you have a family trust. It's existed for 10 years. Kids are in their 20s now and they start getting married. They get divorced. That beneficial interest in the family trust shouldn't be hitting the matrimonial property division spreadsheet that family lawyers will put together. And same with businesses. Your kid, they're into their 20s, into their 30s. They want to start a business and they get into a bit of trouble and the bank comes knocking on the door. Again, they shouldn't be able to come after the family trust assets, which is different if you had perhaps just frozen the company, added them as a non-voting shareholder. What happens if the bank comes knocking at that time? well, those shares are assets of that person, and they can be seized and held by the bank. And all of a sudden, you have a bank who's a co-owner of your PC, perhaps, which is undesirable in most cases.
Right. Okay. So these are the structure of the family trust. It's pretty new to most of us. So let's jump into the juicy part, the tax advantage. So why would the wealthy want to trust, and what's the tax advantage of that?
So the big ticket item nowadays is the multiplication of the capital gains deduction. So capital gains deduction, if you're Canadian and you start and grow a business in a company, sell it for a big capital gain down the line, you get, just about $1 million of shelter on the capital gain that's tax-free as an incentive to, again, start and grow these small businesses. So having a family trust means, you have children who are all under 10, say. You don't really want to issue them shares, but in order to get that capital gains deduction, the capital gain has to accrue in their hands. So if you're not willing to give them shares, you can't just wait till time of sale and then, gift them shares, because that's, there's going to be no capital gain that's going to grow in their hands. So the way to do that is you have a family trust where the value can accrue to all of the beneficiaries, including these children, again, my example, under 10. And then when you sell, you can claim all of the beneficiaries' capital gains deductions if you follow the steps, if you make half of it paid or payable to them, all these things. But it opens up that doorway to multiplication of the capital gains deduction. That's probably the biggest big ticket. There was more income splitting, annual dividend things that went on. Those got shut down by call them the TOSI rules. We've talked about those a couple times here. But you can still, if you have enough assets to have just an investment company or an investment portfolio in a trust, you sometimes can structure it to do income splitting through that.
So let's go back before we go into the income splitting side. So let's go back to the multiplication of capital gains exemption. I think that's a juicy one, right? So if you have a corporation and you're lucky enough that somebody would buy you out, right? I think for PCs it's a bit of a pipe dream because nobody buys your PCs out. Maybe you have, let's say, aesthetics practice, or you have some sort of a family business you create it on the side. Or if you're a dentist, right? There's a very sellable business.
It's becoming more common. Dentists, optometrists, that there's groups that are kind of, aggregating these and combining these and buying them out. And so there are some, and I think there'll be more as we go along.
I've also heard that there are big groups buying up medical clinics as well, right? So if you have a sellable business, right, you would get the capital gains exemption. So let's say you have you, spouse, and 3 kids, or 2 kids, to make it more realistic. So if you do it right, what you're saying, Jason, is potentially, if it's $1 million each, you can potentially have a $4 million capital gain exemption.
Yes, in today's dollars, it's an inflation adjusted amount. So in 15 years when you do sell, might be 1.3, 1.4 million of shelter. Yeah.
Sure, but the crux of this is if you didn't have a family trust, shy of them being your shareholders, you cannot do this.
Yes, shy of having a 6-year-old be a shareholder of your company, and I don't know, do you get them to, do a handprint and paint on the contract? Can they sign things at 6? And even talking about is a contract legal? But yeah,
that's a big ticket item, and that's why the wealthy people have it, right? So okay, let's peel it down a little bit, one level, for some income splitting, right? So you're saying this, a lot have been taken out since the 2017 or 2018 big tax revolution by CRA. So in practical sense, for day-to-day Joe average medical practitioners / business owners, how can they take advantage of the family trust before they sell the business?
Yeah, so there's really the 2 big ones that come to mind from the tax side are some version of income splitting. To the extent kids are active in the business, again, depending on the nature of the business, there may be opportunities to flow funds through the trust to the kids. Or alternatively, if the corporate group is generating surplus cash that isn't needed for operations, you can set up an investment portfolio either directly in the trust or in a subsidiary of the trust to earn investment returns, capital gains, interest, dividends. And those amounts can sometimes be shared with kids or an inactive spouse. because the TOSI rules only generally apply to business income. So to the extent you have passive income, that can flow through the trust. And then the other one is,
can we rewind that? Let's just
Yep.
I want to have a picture there, right? A verbal picture or a pictorial thing. So if you have a PC, right, you have inactive spouse, you have minor kids, TOSI would just kill you, right? If you pay them inaccurately. But if you have a way to have a family trust, so you flow excessive income or asset up from the corporation, not necessarily the MPC, up to the family trust, then the family trust can then distribute some money to the spouse and to the kids. Is that correct?
if it's investment income, yeah.
If it's investment income, not active income.
Correct. Yeah.
Right.
And so if you don't have a separate, so in theory, the CRA has acknowledged that it should be possible to have one company with one trust over top, and the company has both a business and an investment portfolio.
Mm-hmm.
And you just have to do a really good job of tracing, basically just following the dollar through the bank accounts just to be able to show, look, this was a dividend from my shares of a big 6 Canadian bank. I got a $50 dividend and it moved to this bank account and then this one, and it never commingled with the business money. Right. My preference is always just put it in a whole nother company. It just makes it simpler and cleaner and easier. But that's the idea, is that you basically follow the bouncing ball through the structure of the investment income, whether it's in one company or in a separate company. And that should be able to flow out because it's not derived from the active business. The potential issue that made CRA talk about it was it's indirectly, right? Because you have the company that makes the profit, then it invests it into the portfolio. So the question is that derived from the business? CRA has acknowledged that second generation investment income from that capital can be paid out. So again, if in the future you liquidate that portfolio and say, oh, I'm going to pay out that $1 million that's been saved and stashed in this portfolio, TOSI would apply. Because again, that is the business income, that's the capital.
Right.
The income from the capital should be able to be kind of sprinkled, we would call it, and shared.
Right. Okay, so I stopped you from saying the second point.
Yeah, so the other point was, and rewinding to, we talked about that capital gains deduction and the $1 million per beneficiary. In order to get that, you have to meet certain asset tests on the active asset mix of the company. I think we talked about this in an earlier course. We definitely will.
Purification.
Purification. I think we talked about it. We will talk about it again in kind of our end of life cycle masterclass down the line. But the idea is that you need to strip out extra cash and investments, and if you've accumulated a cottage at the lake and a boat that you've been buying in your company, you need to move all these things out because they're not active assets. And family trusts are really good at it, allowing and facilitating that movement of assets from one company to another in a tax-deferred way, that they don't have to be kind of an operating company and a holding company. And that's what I call the magic of family trusts. Is a family trust will own shares of a company, and that company pays the dividend to the trust. The trust will then have a decision. It has 3 options. The trust can hold on to that dividend. If it does, then it's taxed at the highest tax bracket in its particular province, which is bad. You usually don't make that decision. Option 2 is you pay it out to individuals, the beneficiaries, who can then spend that money and use it for, if it's a kid, college, if it's the grown-up, for a mortgage, and then it hits their T1. It gets deducted from the trust, so the trust doesn't report it anymore, and it goes on the individual's T1 return at the end of the year for them to pay tax on it, their marginal tax brackets. So again, if you're a university kid, maybe you've got no income at all. No other income, I should say. Then the third option is the trust can pay it out to another company. In that case, it's treated as an intercorporate dividend, generally should be tax-free. And so you've moved it out of the operating company where there's creditors and risks and all these things, and you've put it into a hold co off to the side. Now, 10 years later, the trust wants to sell those shares. Same issue. Instead of a dividend, it now has a capital gain. Again, the trust can hold on to it, tax the highest brackets. Probably don't do that. You can pay it to another company, and it's going to be taxed at an unfavorable rate as well. So it actually does the opposite. And it says, I'm going to pay this capital gain out to the individuals instead. They get the capital gains deduction. They get a better tax rate than the corporation would. And that's kind of what I call the magic of the trust. It gets to choose its own adventure, whatever fits it best in any circumstance. If it gets a dividend, it can pay it to a company tax-free. If it gets a capital gain, it can pay it to individuals. And the trust is the only shareholder. None of those shareholders have kind of any rights to demand, to see the corporation financials. They don't have minority shareholder rights, to oppression and all these things that they would have, even if they were a non-voting shareholder. And that's the big picture, that flexibility that I alluded to first of having a trust, of organizing your affairs in the best way year to year on what makes sense for you and your family. Right. Having a trust there in the structure really facilitates that.
So would you say that a lot of this kind of benefit really happens when the professional or the business owner decide to retire? Because there's a huge amount of accumulation of assets and investment portfolio.
It depends on kind of who set it up and what their business is and what their family structure is. There definitely are benefits down the line, although we should probably circle back to the 21-year rule and how long, even though trusts can live 50 to 100 years, how long oftentimes they do live. A lot of the benefits can be in retirement. So again, then you've reached the age of 64, and the TOSI rules generally stop applying to you and a spouse. So you have more flexibility to pay amounts to a spouse at that time. Yeah, right. But a lot of and again, if we call retirement, immediately before retirement when you sell your business, again, also that's a good benefit. But you need to have set the trust up before retirement. Trusts are only valuable if they own property that grows in value. And I've seen circumstances where clients will come and they'll say, okay, I've got it happened with it was a pharmacist. They said, okay, I've got a buyer lined up. I'm going to sell my pharmacy for, I don't know, $8 million or something. They said, I've heard about these family trusts. How do we do that? I've got 2 kids and this is great. Well, half of the price will be, shelters. Well, can't do it now. You can't just, the trust doesn't own anything. We can make it a trust, but it's not going to own anything. And if you sell it shares, it's, you have to sell it for its value right now. You can't move it in what we would call can't roll it into a trust.
So therefore you need to plan ahead of time.
Yeah, the value has to grow in the trust. Right. So, yeah.
So let's nail the big timeline thing, right? So you talk about this 50 to 100-year rules, but then we heard this is a very common perception. There's a 21-year thing, and we have had we know friends, people, colleagues that reach that 21-year time and they're panicking, right? And they say they have to dissolve this, dissolve that. So what's your say about that?
So starting with the legal side, trusts do not last just 21 years. Again, trusts are generally creatures of contract with statutory rules backing them up. And so you can put in your contract, this trust will last forever. But then you have to look at the statutes and the court rules around, because generally the idea was there used to be trusts that last forever or purported to, and the court said, we don't like that. We don't like dead people having control over things indefinitely. Mm-hmm. Generally, property is to be used and enjoyed by the living. I think it's there's a phrase they use, like, ruled from beyond the grave, or the cold hand of the dead, or whatever. So generally, it was the courts actually who stepped in first and said, and they made a really confusing rule. It's called the rule against perpetuities. Basically, they just don't want a trust lasting in perpetuity. And so the base rule they made was a trust can only last up to 21 years after the death of a life in being, with a life in being someone alive who's relevant to the trust. Generally nowadays, that's a beneficiary, a trustee, the settlor. So if you make a trust with a 1-year-old grandkid in it, and that person becomes the longest living and they live to 100 years, then in theory, your trust should last 21 years after the death of that person who was 1, then 100. So 121 years in theory. People are living longer and longer. Who knows? There might be a 150-year trust that could exist. So that's kind of the upper limit. Some provinces have made specific rules. Actually, some provinces actually gotten rid of that perpetuity rule and say, you know what, we're actually going to allow trusts to last forever, because they have other rules that kind of curtail what are the downsides of having a trust last forever. And then you have other provinces like BC as an example. BC says trust can't last longer than 80 years. Just kind of
that.
Period, end of sentence. That's just, they said 80 is the maximum. I don't know why they picked 80. There was probably a study. I don't know why that was the magic number, but they said 80. So again, you just have to be mindful. Every province is, I think Saskatchewan and Nova Scotia have done away with the rule against perpetuity. So your trust can last forever. Alberta still has that 21 year after the last to die of the lives in being rule. So that's the legal side of it. Trusts generally can last more than 21 years. But again, you can also have in your trust deed, it says trust will last 5 years because it's a contract. You can say that if you want. A lot of times what happens is it'll say the trust shall last, this maximum period unless the trustees decide to wind it up early. Because again, maybe in 5 years you sell, you've gotten all your benefits out of it. You shouldn't be forced to have a trust around for another 100 years. And so you can always dissolve. Generally, you have the ability to dissolve a trust and wind it up and wrap it up, because nowadays you have to file tax returns and all these things. And there's other rules that are coming in that are making trusts a little more cumbersome. So having the ability to wrap it up is good too. So that's the legal side. On the tax side, the government decided pretty early on that they didn't want trusts. They didn't want people to just put all their property in trusts and then have them last 120 years in my example, because you could have what would be like 4 generations of people dying, passing along the property. Every time a Canadian individual dies, it's a taxable event. The value of the estate is taxed at fair market value with capital gains tax, all these things. They didn't want people to just, put it in a trust, skip 4 generations, get the value of tax-deferred compounding. That seemed unfair to them. So for some reason, they said 21 years is what we're going to call a generational passing of wealth. So every 21 years, a trust is functionally deemed to go through a death. Every 21 years, the trust is deemed to dispose of all of its capital property at fair market value, to reacquire it at that amount, and then to carry on. So that's what people are referring to when they say, hey, a trust lasts 21 years. Because on the eve of the 21st anniversary, the trustees have a decision to make. Do they want to live with the consequences of that taxable event? And I've seen it happen. Either sometimes you don't have a big capital gain, just maybe the markets are down, or the way the trust is operated, it's distributed a bunch of its property, it just doesn't have a big capital gain to deal with. Or the one I saw before was, the next generation just weren't ready to handle it. The tax bill wasn't egregious. And they said, hey, let's get another 21 years at the cost of just paying, whatever the bill was to the CRA, and then they continued on.
Right.
Again, it's not the most common. I've seen it happen. Another option is trusts are only a problem for the government when they're discretionary, because again, they don't know whose hands it's going to get taxed in. And if it doesn't get into anyone's hands, then it's not taxed when they die. So you can go to court and basically ask the court to fix the trust interests, to stop it from being discretionary. So if you had 4 kids in the trust, you could say the trust is now, it's a 25, 25, 25, 25% trust. Each kid basically owns 25% of the property, is entitled to 25% of the income. It's all locked in. From that point forward, the government doesn't care anymore, because when the kid dies, they're going to be treated as owning 25% of the trust property. And so nothing's being defeated anymore by having it in the trust. It's as if an individual owns it. The most common option, so the third option, the most common is to do a tax-deferred transfer out of the trust. So the trust will transfer the property. It'll get to transfer it at its cost amount, so it won't have to have a capital gain on it. And it goes to the beneficiaries in whatever percentages the trustees choose.
Right.
Now, in that case, when the trust hits its 21 years, it doesn't own anything anymore. So there's no event, and people carry on. So again, that one really only works if 21 years has passed and you kind of have a good sense of, if it's a business that a kid can take over, do you know which kid's going to take it over? If not, maybe you give it all back to mom and dad and then you refreeze into a new trust. But yeah, so trusts do live more than 21 years, but on the lead up to the 21st anniversary, you kind of have a decision to make around that. Again, I've seen them go all directions, all 3 options chosen. I've seen I've seen tax advisors miss the 21st anniversary, which is a bad one.
Oh dear.
So
Sure. So there's a whole lot more, right? It's like peeling onion. So thank you, Jason, for the time and the wisdom and for the intro. It is still a very complex topic. And so we would like to invite everyone back to the masterclass. If you're part of it, if not, get enrolled. And we'll go into how we could weave this into advanced tax planning. And so Jason will be back this January 31st. I'll be here with Jason and Nick Giovanatti. That's another faculty member, and he'll put some live examples how it applies to us. So I want to thank you, Jason, for the formal part of this.
Thank you so much for listening to the Physician Empowerment Podcast. If you're ready to take those next steps in transforming your practice, finances, or personal well-being, then come and join us at physempowerment.ca, PHYS empowerment.ca, to learn more about how we can help. If today's episode resonated with you, I'd really appreciate it if you would share our podcast with a colleague or friend, and head over to Apple Podcasts to give us a 5-star rating and review. If you've got feedback, questions, or suggestions for future episode topics, we'd love to hear from you. If you want to join us and be interviewed and share some of your story, we'd absolutely love that as well. Please send me an email at kmilo@physempowerment.ca. Thank you again for listening. Bye.